I'm Jochen Kölschbach, KPMG's Global IFRS Insurance Leader. The International Accounting Standards Board has just published its proposed amendments to IFRS 17 insurance contracts. As expected, the board is proposing a one-year deferral of the effective date to 2022 and amendments to 7 important areas of the standard. These address insurers' concerns and implementation challenges. Even with the extra year, there's still plenty to do to be ready for 2022. You should be thinking about specific impacts the proposals will have on your implementation plans. Let us take a look at the proposals one by one.
First up is the effective date of IFRS 17. The board is proposing to defer IFRS 17's effective date by a year to the 1st of January 2022. It is also proposing to extend the temporary exemption from applying IFRS 9 financial instruments granted to insurers meeting certain criteria. The board is proposing amendments in 7 areas of IFRS 17. These are accounting for certain types of credit cards and loans that provide insurance coverage, accounting for investment services in an insurance contract, allocating insurance acquisition cash flows, mitigating the financial risk of direct participating contracts, presentation of insurance contract assets and liabilities, reinsurance of onerous contracts, and accounting for acquired claims liabilities on transition to IFRS 17. Let's start by looking at the accounting for certain types of credit cards and loans. The board is proposing to exclude certain credit card contracts that transfer significant insurance risk from the scope of IFRS 17. The board is also proposing that issuers of loans that transfer significant insurance risk would have the option to apply either IFRS 17 or IFRS 9 to them. The second area is accounting for investment services in an insurance contract. The board is proposing to amend the pattern of profit recognition under IFRS 17 to reflect the provision of investment services, and to clarify the definition of an investment component. For direct participating contracts, the profit recognition pattern would reflect the period in which insurance coverage and any investment-related services are provided. Similarly, for all other insurance contracts, the profit recognition pattern would reflect the period in which insurance coverage is provided, along with any investment return service, a new concept introduced in these proposals. This would better align the accounting under IFRS 17 with the services provided under the insurance contract. The third area is allocating insurance acquisition cash flows. Insurance acquisition cash flows, such as initial commissions that are paid on a newly issued contract, can sometimes render that contract onerous under IFRS 17, because the higher acquisition cash flows are paid in expectation of future contract renewals that are outside the initial contract's boundary. The board is proposing to require insurers to allocate part of the insurance acquisition cash flows for initial contracts like these to the expected renewals. This means that contracts like these might no longer be onerous. Let's take a look at the fourth area, mitigating the financial risk of direct participating contracts. Changes in the financial risk of direct participating contracts are usually accounted for by adjusting the CSM. Insurers are allowed to recognize these changes in profit or loss when derivatives are used to mitigate the financial risk of these contracts. This is called the risk mitigation option. This avoids accounting mismatches that would otherwise occur when recognizing the changes in the fair value of the derivatives in profit or loss under IFRS 9. The board is proposing to permit insurers to use the option for reinsurance contracts held as well as derivatives. This proposal would avoid accounting mismatches from arising when reinsurance contracts held are used to mitigate the financial risk of direct participating contracts. The risk mitigation option is prohibited from being applied retrospectively because it could result in the use of hindsight. If risk mitigation activities were in place before the date of initial application of IFRS 17, then this prohibition may distort revenue recognized for groups of contracts in future periods and equity on transition because of differences in accounting treatment between insurance contracts and related risk mitigation activities. The board is proposing that, subject to certain criteria, the risk mitigation option could be applied prospectively, and the fair value approach to transition could be used even if a full retrospective approach is possible. The fifth area is presentation of insurance contract assets and liabilities. Under IFRS 17, many groups of insurance contracts would be in a liability position, while some could be in an asset position. But in most cases, the portfolio in aggregate will be in a liability position. The board is proposing that insurers be required to present separately on the balance sheet, at portfolio level rather than group level, the carrying amounts of insurance contract assets and insurance contract liabilities. This would provide practical relief to insurers who may find it difficult to allocate cash flows to individual groups of insurance contracts. Next up is the sixth area, accounting for reinsurance of onerous contracts. The board is proposing that if an insurer recognises a loss on underlying insurance contracts that are onerous at initial recognition, then it would also simultaneously recognise a gain in profit or loss on reinsurance contracts held, to the extent that the losses are covered on a proportionate basis. Recognising this gain would avoid an accounting mismatch caused by recognising only the losses on the underlying insurance contracts, but not the gains on the reinsurance contracts held at initial recognition. The seventh and final area relates to acquired claims liabilities on transition to IFRS 17. IFRS 17, as originally drafted, requires insurers to account for claims liabilities in two different ways, depending on how they arise. Claims liabilities under contracts issued by an insurer are accounted for as a liability for incurred claims. The treatment of claims liabilities under contracts acquired by an insurer, either in a business combination or portfolio transfer, depends on when the claims were incurred. If the claims were incurred after the date of acquisition, then the claims liabilities are classified as a liability for incurred claims. Otherwise, they are classified as a liability for remaining coverage. This poses a challenge to some insurers who may not be able to distinguish claims liabilities in this way. The board is proposing to add a further modification to IFRS 17's transition requirements that would permit insurers to account for all such liabilities as a liability for incurred claims, where there is insufficient information to split them into two categories. This would eliminate the challenge of recording claims liabilities in different ways if the information is not available. What should insurers do next in the light of all these changes? Here's Mary Trussell with some helpful advice.
The proposed amendments to IFRS 17 insurance contracts are certainly very helpful, but implementing IFRS 17 will still be a complex and significant undertaking for insurers. You'll need to upgrade and overhaul your systems, processes and controls, and thoroughly test them before producing your first set of IFRS 17 results. It's vital that you make good use of the extra year. Don't wait until the final standard is released to get going. Right now, you should have a laser focus on working through how the board's proposals will impact your specific business and implementation plans, and this will help you to identify any concerns you need to communicate to the board and work out what the changes mean for the design of your IFRS 17 systems. The publication of the board's exposure draft fires a starting gun for IFRS 17 implementation teams. It's a signal to banish project fatigue and reinvigorate your implementation efforts. We're here to help support you on the race to the finishing line.
To find out more about the amendments to IFRS 17 and how the new standard will impact insurers' business, visit home.kpmg/IFRS 17.